Have you ever wondered why some investors always seem to be picking winning companies while others struggle to even get started? Here is the truth. It's not luck. They follow a very simple checklist that I learned and practiced during my years working in private equity here in London, and it completely changed how I approach every single investment. In this video, I'm going to walk you through the 5 exact steps I use to evaluate companies, the same steps top investors use every day to make sure their money is safe. So whether you're just starting or looking to level up your strategy, this will give you a clear and structured way to think like the pros. And if you stick around till the end, I've added a free Google Doc with my full investment checklist so you can use it yourself right away. Plus, Part 2 is coming next, where we'll cover the same step, but with more depth. So make sure you hit like and subscribe now, and let's dive in. First, we start with the health check of the P&L. So that's the profit and loss statement. Think of it like a company's financial report card, showing how much money they make and spend over a set period. The very first thing I check is revenue growth. Are sales going up or down? Growing revenue often happens because the company is increasing the price of their product, or because they just get more customer over time. But growing sale alone isn't enough. Next, you have to look at the profit. That's what's left after all the expenses, things like production costs, salaries, marketing, and taxes. If profit shrinks but revenue grows, it means costs are rising too fast, or the company is not pricing their product well. Imagine you sell more lemonade, but you spend even more on ingredients and cups, so your leftovers cash is actually shrinking. Not a good place to be. Also, watch the profit margin, which is profit divided by revenue. Healthy margins often separate a very good company from the rest. A company making 10 million profit in 100 million sales is a 10% margin, which is much stronger than the same company making the same amount of sales, but 5 million profit on that. So that's a 5% margin. One other useful metric is the operating income, which shows the profit from core business operation before taxes and interest. You want to look for a consistent and growing operating income, which means that the company is efficiently managing the main business, which is a great sign. As an example, think about a tech company reporting steady revenue growth of 10% yearly, but a declining operating income. That means maybe expenses are way too high on R&D or marketing, but the company isn't yet turning those investments into profit, which could be a red flag. So to summarize, check the P&L of the company you want to invest in. Calculate the growth of the revenue year by year. Calculate the profit margin and check if it's positive. And benchmark both the revenue growth percentage and the profit margin against competitors. If revenues are growing and profit margin are looking good, that's a green flag for your stock. Second, I want to know if the company actually produces cash, the real money flowing in and out, called cash flow. Profits on paper don't always mean money in the bank. Companies can use accounting tricks or delay payment to make profit look better temporarily. But cash flow tells you if a company really has the liquidity resources to pay bills, invest in growth, and return money to the shareholders like us. So think of running that lemonade stand again. You might have made £100 in sales, but if everyone owes you £90 and hasn't paid yet, your cash drawer only looks like £10, and that's a bit risky. The 2 key cash flow metrics I look at are the operating cash flow, which shows cash generated from day-to-day business. Positive, growing operating cash flow is a green light. I also look at the free cash flow, which is the operating cash flow minus capital expenditure, also called CapEx. So CapEx is the money spent on buildings, equipment, or product development, and it shows how much cash is left after reinvesting in the business. So to recap, check the cash flow statement, check if the operating cash flow is positive, what's the most drain on operating cash flow? Try to figure this out, and check if the free cash flow is positive. How much are they spending on CapEx? What CapEx do they have? If the company has a healthy cash flow statement with a good amount of cash flow generation and reinvestment, that's another green flag. You can pause here and take a screenshot of this, or you can download my Google Docs in the link in the description if you prefer. Next is the company's positioning in its industry. Honestly, this is one of the hardest steps. I've made mistakes here before. Once I invested in a company with great financials, like we just said, but I didn't see that their main competitor was about to launch a completely disruptive product. So you have to figure out, where does the company stand among competitors? Is it a leader, a challenger, or is it getting squeezed out? Picture the stock market like a sport league. The best teams have loyal fans, winning records, and the best players. In business, that's exactly the same things. Strong brands, valuable patents, and unique tech that competitor can easily copy. I also look at the industry itself, whether it's a growing or a shrinking industry. Investing in a top player in a fast-growing industry is often safer than investing in a leader in a declining market. So, for instance, renewable energy companies benefiting from rising demand in clean power. But if you look at traditional energy firms like petrol, they might have shrinking markets with all the regulation and the public pressure they face right now. I also pay close attention to the company's market share, which is basically the slice of the total industry sale they control. When a company's market share is growing, it usually means that they are winning customers from competitors, launching popular product, or expanding into new regions. But on the other hand, a declining market share can be a red flag. If a company's share of the market shrinks, it may mean competitors are taking customer away, or the company's products are becoming less popular or, even obsolete. It's important to compare market share trends against the overall industry growth. Sometimes a company's market share may drop, but the whole industry itself is growing. So if you only look at the company's sales number, they might well be still increasing, and you won't even notice that they're actually losing share. And on the other hand, even a stable market share in a shrinking market means that the company's sales could be declining. So I often use this very simple table, which is called the BCG matrix, named after the Boston Consulting Group, which divides company into 4 categories. So you have the stars. These companies have high market share in growing industries. Think of them like high-scoring champions with loads of fans, strong and positioned for future growth. You have the cash cow. These have high market share, but low growth markets. They generate steady profit and cash flow, but aren't expected to grow much. Imagine a reliable veteran team that keeps winning, but it's not the flashiest. Then you have the question marks. These have low market share in growing markets. They have potential, but need investment to become stars, or they might fail. They're like the rookie teams with big potential, but kind of uncertain future. And then you have the dogs. These have low market share in a shrinking markets. They tend to struggle and are often risky investments. Picture struggling teams with few fans and poor records. This BCG matrix is really helpful for any investment. It's super simple to understand. But don't worry about remembering it because it's included in my Google Docs below. So to recap, check if the industry of the company is growing and by how much. Figure out the company's market share and try to place the company in the BCG matrix in the 4 categories that they have. And if you're finding this helpful so far, tap like and remember to subscribe for more investment guidelines just like this. The 4th point for me is to understand the direction of travel of the company. So that's the company's future path. Past results matter, but the future is what really drives the stock price. Are they innovating? Are they entering new markets? Are they cutting costs? For this step, you have to look inside what the company is doing, but also outside what other competitors are doing as well. For the inside part, look for a recent announcement, new product, partnership, or expansion. You can read quarterly earnings calls, management commentaries, and analyst reports. That can give you a good idea of direction of the company. For example, a tech company releasing AI features could show some pretty strong growth potential, especially now in the market where we're in. Now, on the flip side, if the company struggles with outdated products, regulatory issues, or management turnover, that's a big warning sign on the direction of travel of this company. So you just have to watch out. For the outside checks, you must really know the competitors and what they're doing for their direction of travel. Are the competitors investing in a completely different set of technology, for example? For instance, look at Meta or Facebook. They're pouring a lot of money into the metaverse, and they're pretty much the only one doing it at this scale. That's completely differentiated for them and a completely different direction of travel where they're pretty much on their own. Quite interestingly, having a very strong P&L, cash flow, and industry characteristic often leads to a strong future potentials, but it's not always the case. Take the example of Apple, for instance, looking at it like today in 2025. They have all the green flags of the 3 previous steps, the good P&L, the good cash flow, the good market share, The step 4, direction of travel, is kind of unsure. Siri hasn't been updated or improved in a while. They haven't done a lot of AI investment compared to all their competitors. And more people are kind of scratching their head really on where will Apple be in like 10 years. So to recap, read companies' earning reports and market reports. Figure out their plan for the future and compare this plan with their competitors. Finally, as a last step, I have a look at the company's historical stock price movement. How has the stock reacted to earnings, news, and any other like previous financial crisis? I'm also checking if the stock has been stable or more up and down and volatile. Having an idea of how the stock has moved up and down can really help set realistic expectation. And all the above steps should be, in theory, reflected in the stock price chart. So if the company is doing really well, then the stock price will obviously have a nice and upward trend line. Now, if the stock has had a bit of a rocky past, it will be shown in the stock price movement as well. Say, take like Salesforce. This is a software company who provides CRM system, so one of the biggest in the world, and they help companies organize their customer journey and customer inquiries. So on the face of it, it looks like a pretty strong company, right? Well. Check their stock price charts. So it's up on the back of COVID, like the majority of stock, to be honest. But then it had a few spikes, but it's kind of difficult to read the chart. And I'm not even sure, looking at this, the investment sentiment on Salesforce after all. Like, I'm not sure it's that great. So to recap, have a look at the stock price chart. Try to understand the drops and the spikes, like what's driving these spikes. Right, so to wrap up, the 5 steps to follow when considering investing in a companies are: firstly, check the health of the P&L. Second, work out the cash flow generation of the business. Third, understand its place in the industry. And fourth, check the company's direction of travel. Last but not least, study the historical price movement so you don't have any surprises. I've personally used these steps in my job in the private equity industry for a very long time, and they really help to make informed investment, and often in pretty good companies. So don't forget to download my Google Docs below so you can use this checklist right away for your investment decision as well. These steps are accessible to anyone. You don't need to have a degree or work in the top management firm to follow them. And safe and smart investment are for everyone, not just for the experts. So thank you for listening. If you found this helpful, please like, subscribe, and leave a comment about your own investment checklist. See you in the next video.